Hey everyone, welcome back to Corporate Decoder, the place where we decode the hidden stories inside the world of finance. And today we are diving deep into Mobix Labs Inc. report, a company that sounds like it is straight out of a sci-fi movie. Let's see if their numbers are as futuristic as their name. Before we dive in, if you love getting these unfiltered insights from corporate filings, make sure to subscribe and ring that bell. And hey, we have a growing community over on Discord where we break down these documents even further with the link right in the description below. Come join the conversation. Now let's talk about earnings, or in Mobix Labs' case, a significant net loss for the year ended the 30th of September 2025. Their net loss was a hefty $46.1 million. That is up from a loss of $20 million in 2024. This is a big jump in losses, and it tells us the company is spending a lot more than it is making, which isn't surprising for an early stage tech company, but the scale of the increase in losses is definitely something to watch. Looking at revenue, it is a mixed bag. Total net revenue actually jumped by 54% to $9.9 million in 2025, mostly driven by a huge 609% increase in services revenue. Product revenue saw a small uptick of 2%. Now this surge in services revenue comes after acquiring Rage Systems in May 2024, so while it looks like growth, it is largely due to adding new businesses, not necessarily organic soaring sales of their original products. Their spending on research and development has actually gone down significantly. For 2025, R&D expenses were $2.4 million, a massive 58% drop from $5.7 million in 2024. The company says this is due to headcount reductions and cost-saving measures. While cost savings are good, cutting back on R&D can sometimes signal a slowdown in innovation, which is crucial for a tech company like Mobix Labs. Selling, general, and administrative expenses also saw a slight decrease of 5%, coming in at $39.5 million in 2025. This decrease is attributed to lower outside services and compensation costs, partly offset by increased expenses from acquired businesses. So they are trying to control costs, but a lot of that is being absorbed by the new acquisitions. Let's look at some more unusual items. The change in fair value of their earnout liability shows a gain of $440,000 in 2025. This might sound like good news, but remember, an earnout liability is essentially a promise to pay extra money later, often based on stock performance. A gain here usually means the company's stock price has fallen, making that future payout less valuable. It is not a sign of operational strength, but rather reflects a drop in their stock's market value. Now turning to the balance sheet, as of the 30th of September 2025, Mobix Labs had about $3.2 million in cash. That might sound good, but look at their current liabilities, which are almost $27.8 million. This means they have more short-term obligations than cash on hand, a situation known as a working capital deficit. This is a clear sign that they need more money to operate smoothly. Their cash position is even more concerning when you look at their debt. Total debt stands at over $6.1 million, with a significant chunk of that being current. Their ability to continue as a going concern is something management itself has expressed substantial doubt about. This means there is a real possibility they might not be able to meet their financial obligations in the near future without raising more capital. Adding to the financial strain, they have a considerable amount in notes payable, including nearly $2.3 million in promissory notes to related parties at a 7% interest rate. These are essentially loans from people connected to the company, and paying them back along with interest adds another layer of financial pressure. Let's look at cash flow, which paints a stark picture. In 2025, Mobix Labs used $10.1 million in cash from operations. This is an improvement from 2024 when they burned through almost $18.4 million. But remember, improvement here means they lost less cash. They are still bleeding cash from their day-to-day business activities. Investing activities show they provided about $1 in cash in 2025. This is compared to using over $1.1 million in 2024, mainly for acquisitions. This near zero figure in 2025 suggests they are not making significant investments in new assets or businesses right now, likely due to their tight financial situation. The financing activities section is where they get their cash. In 2025, they brought in over $13 million. This came from selling stock and warrants and exercising warrants. This is how they are staying afloat, by constantly bringing in new money through these financial maneuvers, rather than from selling their products and services profitably. Moving into the notes section, which explains the numbers in detail, we find some critical information. The company acknowledges that it has incurred operating losses and negative cash flows. They expect these losses to continue and will need to raise more debt or equity financing to keep running. They explicitly state there is substantial doubt about their ability to continue as a going concern, meaning they might not be able to operate for the next 12 months without new funding. A fascinating detail here is about the contingently redeemable common stock issued as part of the ME Solutions acquisition. The terms allowed sellers to demand their shares be repurchased for cash, making them not fully permanent equity. However, the merger with Chavant changed this, and these shares are now considered permanent equity. This illustrates how complex even basic ownership structures can become. In the summary of significant accounting policies, their approach to the merger is explained as a reverse recapitalization. This means that for accounting purposes, Mobix Labs is treated as if it acquired Chavant, even though Chavant was the publicly listed entity. This is a common accounting treatment when a private company effectively takes a public shell company public. When valuing certain instruments like their earnout liability and warrants, they use level 3 inputs. These are essentially unobservable inputs, meaning they are based on the company's own assumptions, not readily available market data. This adds a layer of uncertainty to those valuations, as the numbers are highly dependent on management's own projections and beliefs about the future. The company's net loss per S-share is quite telling for 2025. Basic net loss per S-share for Class A common stock was $1.01. With dilution, it remains $1.01. This means even when you consider all potential shares being issued, each share lost over $1. The sheer number of shares outstanding over 45 million for basic calculation in 2025. And still a huge number of potentially dilutive securities left out because they would be anti-dilutive, highlights the extensive share issuances and the resulting impact on per S-share value. Their risk factors section is extensive, but a few stand out. They're an early stage company, which is standard, but they also admit it is difficult to evaluate their future prospects. They can't predict revenue growth, and they continue to incur losses with substantial doubt about their ability to continue as a going concern. They also highlight the heavy reliance on a single customer accounting for 50% of their revenue in 2025. Losing that customer would be devastating. Another major risk is their listing on the Nasdaq. They have received delinquency notifications for not maintaining the minimum bid price and minimum market capitalization. If they can't regain compliance by their deadlines, their securities could be delisted, which would severely limit trading and their ability to raise capital. This is a critical hurdle they must overcome. Analysts, so what is our take on Mobix Labs? They are clearly in a very tough spot. They've made some strategic acquisitions like ME Solutions and Rage Systems, which have boosted their revenue, but at what cost their losses have significantly increased. And more importantly, they are very open about their struggle to continue as a going concern. Their cash balance is extremely low relative to their liabilities, and they are heavily dependent on future financing. The good news is they have a significant amount of R&D experience and intellectual property. However, the massive increase in R&D spending cuts from the previous year is concerning for a company in such a competitive and fast-moving tech space. Their biggest strength is probably their experienced leadership team, which is crucial for navigating these challenging times. The biggest risks are their cash burn rate, their Nasdaq listing status, and that heavy reliance on one major customer. Realistically, Mobix Labs has a long road ahead to achieve profitability and stability. Investors will be watching closely to see if they can secure the necessary funding and manage their costs effectively without stifling essential innovation. It is a situation that requires a lot of careful financial management and strategic execution. That is our deep dive into Mobix Labs Inc. Its latest filing. What are your thoughts on their chances of turning things around? Let us know in the comments below if you found this breakdown helpful. Smash that like button and subscribe for more corporate financial analysis. And don't forget that Discord link in the description. Thanks for watching, and we'll see you in the next Decode Finalysis.